Anaconda copper breaks $300. Every indicator says hold. The trend is perfect. Your position is massively profitable. But Jesse Livermore sells his entire 8,000 shares in 27 minutes. The next morning, Anaconda crashes 75 points. How did he know? The market didn't announce the crash. There was no news, no earnings warning, no obvious signal. But Livermore saw something nobody else saw, an abnormal movement, a whisper of danger in a sea of confidence. Today, you'll learn the complete warning system he developed across 40 years. The same pattern deviation detection that saved him from disaster multiple times. Drop a comment. Have you ever held a winning position too long and watched it turn into a loss? Every trader knows how to enter a position. You have your setup, you have your trigger, you execute. But here's where 95% of traders destroy their accounts. They have no systematic method for getting out. They hold winners hoping they'll go higher. They hold losers hoping they'll recover. And they sit paralyzed, watching their account bleed because they don't know how to read the warning signs. Think about it. You buy a stock at $50. It runs to $70. You're up 40%. Life is good. Then it pulls back to $65. Just a normal pullback, you tell yourself. Then $60. It's consolidating. Then $55. I should probably get out. Then $50. You're back to break even, kicking yourself for not selling at 70. This happens every single day to traders around the world. Not because they're stupid, not because they lack discipline, but because they never learned to distinguish between normal movement and abnormal movement. Jesse Livermore understood something profound. The market communicates through deviation. When a stock behaves the way it always has, you hold. When it suddenly behaves differently, you act. Not tomorrow, not after confirming the change. Immediately, like a doctor seeing abnormal vital signs, doesn't wait for the patient to code before intervening. Now, Livermore documented this across multiple chapters in his book, but he never assembled it into one complete system. He'd mention abnormal reactions in Chapter 2, reference unusual volume behavior in Chapter 5, describe his gut instinct in Chapter 6, discuss sector divergence in Chapter 8. These weren't separate concepts. They were pieces of a unified warning system. Today, I'm assembling that complete system for the first time. The same detection method that allowed Livermore to exit Anaconda at $300 before it crashed to $225. The same framework that woke him up at night when something was wrong, even though every analyst said everything was fine. Before you can detect abnormality, you must first understand what's normal. This is where most traders fail. They have no baseline. They don't know what a 2-point reaction means versus a 6-point reaction because they never established what's typical for their stock. Livermore wrote explicitly, never be afraid of the normal movement, but be very fearful of abnormal movements. Notice the word normal. He didn't say small or acceptable. He said normal, meaning the established pattern, the expected behavior, the baseline the stock has demonstrated repeatedly. Here's how you establish normal. When you enter a position, start tracking its behavior patterns. How big are the typical pullbacks? If a stock is in an uptrend and consistently pulls back 2 to 3 points before resuming, that's your normal reaction size. How long does it consolidate? If it typically pauses for 3 to 5 days before the next leg up, that's your normal time pattern. How does volume behave? If advances happen on expanding volume and pullbacks happen on 50% less volume, that's your normal volume signature. The amateur never does this work. They see a 4-point pullback and panic, but they have no idea if 4 points is normal for this stock or a danger signal. They're navigating blind. The professional has documented the normal pattern. They know exactly what this stock typically does. And when it deviates from that pattern, they notice immediately. Think of it like a doctor monitoring a patient. Normal resting heart rate is 70 beats per minute. Normal blood pressure is 120/80. The doctor doesn't panic at 72 BPM or 115 over 75. Those are within normal range. But if heart rate suddenly jumps to 110, that's abnormal. That's a warning sign requiring investigation. Livermore demonstrated this perfectly with his stock records. He kept detailed notes on how stocks behaved. He wrote, I could remember in detail how the prices had acted on the previous day, just before they went up or down. This wasn't photographic memory. This was systematic observation of normal patterns, creating a baseline against which abnormality could be measured. Now that you understand normal, you can detect abnormal. Livermore identified 5 types of abnormal movement. Each one is a warning signal. Some are yellow flags. Some are red alerts. But all demand immediate attention, abnormal reaction size. Livermore stated it directly. By abnormal, I mean a reaction in one day of 6 or more points from an extreme price made in that same day. Something it has not had before. If your stock typically pulls back 2 to 3 points, and suddenly it drops 8 points in one session, that's not normal. That's abnormal. The pattern has broken, abnormal time behavior. Your stock has been making steady progress, advancing every week or two. Suddenly it goes sideways for 3 weeks with no progress. Same price level, going nowhere. That's time abnormality. The momentum has died. Abnormal volume patterns. This is subtle but critical. Your stock breaks out to new highs on what should be explosive volume. But the volume is actually less than previous breakouts. Or worse, massive volume appears but price barely moves. That's distribution disguised as strength. Abnormal volume to price relationship. Abnormal weakness against the group. Your stock is in the tech sector. Every other tech stock is making new highs, but your stock is flat or declining. That's relative weakness, an abnormal deviation from its peer group. Something is wrong with your specific stock, even though the sector is healthy. Abnormal speed change. Livermore described this perfectly. The stock could easily go from 60 to 68 or 70 without encountering a natural reaction. As long as the stock is acting right and the market is right, do not be in a hurry to take a profit. But then, all of a sudden, it has an abnormal break of 7 or 8 points. That is an immediate danger signal. The keyword is sudden. The stock was advancing smoothly, predictably. Then suddenly, violent reversal. The rhythm broke. That's abnormality screaming at you. Here's what the amateur does. They see the 8-point drop and think, well, it was up a lot. It's due for a pullback. They rationalize the abnormality away. They explain it. They justify holding. Fatal mistake. The professional sees the 8-point drop and thinks, this stock has never done that during this entire move. Something changed. I don't know what. I don't need to know what. The pattern is broken. I'm out. Let me show you the system in action with the trade that proves everything. Anaconda Copper. The story is documented in Livermore's book, but scattered across different sections. When you assemble the pieces, the pattern is unmistakable. Anaconda approaches $100. This is a major psychological level, a pivotal point. The stock crosses $100 and explodes. Within days, it surges 10 to 15 points with barely a pause. Massive volume. Clean, powerful advance. Livermore accumulates a large position. This is normal behavior for a stock, breaking a pivotal point. He's seen this pattern dozens of times. He holds confidently. Months later, Anaconda approaches $200. Same setup. The stock crosses 200 and again surges 10 to 15 points immediately. Same pattern. Same explosive strength. Livermore adds to his position. The normal pattern is repeating exactly as expected. He's making a fortune. Now Anaconda approaches $300. Livermore is watching closely. He knows the pattern. At 100, it exploded. At 200, it exploded. At 300, it should explode. This is the established normal behavior for this stock at pivotal points. The stock crosses $300, but something is different. Instead of surging 10 to 15 points immediately, it crawls to $302.75. Then it stalls. It struggles. The next day, it's still around 300. The volume is heavy, people are buying, but the price isn't advancing. Livermore recognizes abnormality instantly. He wrote, "It sold only to 302.34. Plainly, it was flashing the danger signal." The word plainly is critical. To him, this was obvious. The pattern that worked at 100 and 200 had broken at 300. Something changed. He doesn't wait for confirmation. He doesn't wait for news. He doesn't call his broker for analysis. He acts. 8,000 shares sold in 27 minutes. From $300 down to $298, he liquidates everything. The next morning, Anaconda opens sharply lower. Within days, it's at 275. Within weeks, 225. A 75-point crash from the top. Everyone who held because the trend is your friend got destroyed. Livermore walked away with his profits intact because he recognized abnormal movement and acted on it immediately. Years later, it was revealed that major insiders had been distributing massive positions at $300. That's why the stock couldn't advance, selling pressure from those who knew something. But Livermore didn't need to know about the insider selling. The market told him through abnormal price behavior. The warning was written in the tape. There's another dimension to abnormality detection that Livermore described, but most people miss. It's the sleep test, and it's saved me personally more times than I can count. Livermore wrote about this in Chapter 6. He'd be holding large positions. The market looked fine during the day. Every indicator was positive. But after the market closed, he'd become restive, uncomfortable. That night, he couldn't sleep soundly. Something would jog him awake. He'd lie there thinking about the market, unable to articulate exactly what was wrong. The next morning, he'd be almost afraid to look at the newspapers. And invariably, the next day, the market would turn against him. This isn't mysticism. This is your subconscious mind processing thousands of observations faster than your conscious mind can articulate. You've seen this pattern before. You've cataloged normal behavior. Your subconscious detects deviation before you can put it into words. Livermore gave a perfect example. He was short 3,500 shares of sugar at $105. The stock declined to $103. Everything looked perfect. His trade was working, but he wrote, "I began to feel uncomfortable. I thought I ought to get out of the market." No logical reason, just a feeling. But he trusted it. He closed the entire position at 103. Moments later, sugar exploded to 108. The bucket shop had manipulated the price to wipe out the shorts. Every other short seller was destroyed. Livermore walked away unscathed because he trusted the abnormality his subconscious detected. The amateur ignores these feelings. "I'm just being paranoid. Everything looks fine. I'll hold." The professional has learned through experience that when sleep is difficult, despite the market looking good, something is wrong. The instinct is pattern recognition, operating at a subconscious level. If you can't sleep soundly despite your position being profitable, that's abnormality. Your subconscious is warning you. Trust it. Exit the next morning. You can always re-enter if you're wrong, but if you're right, you've saved yourself from disaster. The final abnormality signal is sector divergence. This one is subtle but incredibly powerful. It's pattern deviation at the macro level. Livermore described this in Chapter 8 when discussing the 1939 market. He wrote, "Anyone keeping records according to my method would have had their attention drawn very forcefully to the action of the steel stocks." What happened? Every other sector, motors, aircraft, utilities, mail order, was making new highs. But steel stocks refused to advance. They lagged. They acted weak. This is abnormal at the sector level. When one group deviates from the behavior of all other groups, something is wrong with that specific group. You don't need to know why. The divergence itself is the warning. 4 months later, it was revealed that the British government had dumped over 100,000 shares of U.S. steel. But by the time that news was public, steel stocks were down 26 points. The divergence was the early warning. Those watching sector behavior got out. Those focused only on their individual stock got crushed. Apply this to your current positions. Is your stock acting differently than its sector? If you own a semiconductor stock and every other semiconductor is surging but yours is flat, that's relative weakness. That's abnormality. Something specific to your stock is wrong. Is your sector acting differently than the overall market? If the market is making new highs but your entire sector is lagging, that's sector level weakness. The rotation is leaving your sector behind. The professional watches 3 levels: individual stock behavior, sector behavior, market behavior. When all 3 align and behave normally, confidence is high. When any level shows abnormal deviation, attention increases. When 2 levels show abnormality, exit immediately. When all 3 show abnormality, the disaster is already here. Livermore understood this layered approach. He didn't just watch his stocks. He watched their sectors. He watched the market. And when divergence appeared, when normal pattern broke, he acted. Let's synthesize this complete abnormal movement warning system into one unified framework you can apply starting today. Step 1 is establishing your normal pattern. The moment you enter a position, begin documenting its typical behavior: reaction size, consolidation time, volume patterns, advanced speed. Create the baseline. This is your definition of healthy for this stock. Without this baseline, you cannot detect abnormality. Step 2 is monitoring for deviations. Every day you hold the position, compare current behavior to the established normal. Is today's reaction twice as large as typical? Is consolidation lasting twice as long? Is volume diverging from price? Is your stock lagging its sector? These are abnormality flags. Step 3 is the action protocol. First abnormal signal, tighten your stops and increase monitoring. Second abnormal signal, exit 50% of the position. Third abnormal signal, exit 100% immediately. Don't wait for the fourth signal. By then, the crash is underway. Step 4 is trusting the sleep test. If you cannot sleep soundly despite the position appearing fine, your subconscious has detected pattern deviation. Exit the next morning. This is instinct built on observation. Honor it. Step 5 is watching sector and market context. Your stock doesn't trade in isolation. When it diverges from its sector, or its sector diverges from the market, those are macro-level abnormalities that compound individual stock warnings. The complete system transforms exit strategy from emotional reaction into systematic detection. You're no longer guessing when to sell. You're monitoring vital signs. When vitals are normal, you hold confidently. When abnormality appears, you act immediately. This is what separated Livermore from every other trader. Most traders entered well, but they exited poorly. They held too long. They ignored warnings. They rationalized abnormality. Livermore developed abnormality detection into a science. He documented normal. He recognized deviation. He acted on warnings. The result? He exited Anaconda at 300 before the crash. He closed sugar shorts before manipulation. He got out of steel stocks before the British dumping, not because he was lucky, because he systematically detected abnormal movement and honored the warning every time. Now let me be clear. This requires discipline most traders will never develop. Selling a profitable position because of a feeling or because the pattern isn't quite right goes against every instinct. Exiting when abnormality appears, but disaster hasn't struck yet requires courage. Most traders won't do it. They'll wait for confirmation. By then, it's too late. Will you be different? Here's my challenge to you. Look at your current positions right now. For each one, ask yourself, do I know what normal behavior is for this stock? Can I articulate its typical reaction size, consolidation patterns, volume signatures? If you can't, you're trading blind. You have no way to detect abnormality. Starting today, document the normal pattern for every position you hold. Then watch for deviations. 1 abnormal signal, increase attention. 2 abnormal signals, reduce position. 3 abnormal signals, exit completely. And if you wake up at night, unable to sleep despite everything looking fine, trust that warning. Your subconscious sees what your conscious mind hasn't articulated yet. If you're serious about understanding Livermore's complete methodology, read How to Trade in Stocks, published in 1940. The abnormal movement system is there, scattered across chapters 2, 5, 6, and 8. I've assembled it for you, but reading his words directly will deepen your understanding. Link in the description. If this changed how you think about exits, hit that like button. Subscribe for more frameworks from legendary traders. Drop a comment. Have you ever ignored an abnormal movement and regretted it? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Livermore's strategies require study, practice, and discipline. Always do your own research and never risk more than you can afford to lose.